What is going on, everyone? I hope everyone is having a fantastic day. And in this video, I will be breaking down how the intraday drawdown and the end of day drawdown work when trading for a prop firm. So we'll also be talking about the pros and cons of each one. And also at the end of this video, I'll be sharing a strategy that you can trade that's free across most platforms, and also how to adjust this strategy for whatever type of drawdown you are currently using at whatever prop firm you're trading at. And also, if you're new here, subscribe and like if you like it. Have any questions, feel free to ask down in the comment section. I always answer every single question. And also, if you're looking to purchase any of these accounts at Tradeify or Apex, use code ACT. That's ACT, and just to support the channel a little bit. So let's go ahead and get started. So what exactly are these two type of drawdowns? There is intraday drawdown, and this is the advanced plan at Tradeify. Um, and so let's talk about that first. So what's intraday drawdown? Just like it says here, the intraday trailing drawdown fluctuates in real time as you get a new high water mark. And I'll explain what that means here in a minute. But just like it says on your screen right here, every time your account hits a new high in the balance during the day, the trailing drawdown shifts up and your balance drops below the drawdown level this session. You fail. Right, so like in this example here, like it says here, if you have a $50,000 starting balance, you have a max drawdown of 2,000. You can't let your account get below 48,000, right? That's a $2,000 difference. So, but let's say we grow your account up to 51,500 during the day, and your new drawdown shifts up to 49,500. So it's shifting up because you are now in the profit by $1,500, right? It's shifting up. And if your balance ever dips below 49.5 during the day, you blow the account, even though you're profitable. And I'll draw an example here. And so let's actually go like this. So let's just say you enter a trade right here, and then it goes up. And then we all know that the market fluctuates, right? So let's just say it goes up to here, and then up here you are up $1,000. But the trend is still up. Say you think it's still going to trend higher. So you're up 1,000 bucks here. So now your account's at 51,000. It pulls back down a little bit here. And then let's just say it holds here, and then it balances out here, sorry, and then it goes back up another one, and then let's just say you cut that flow, and now you're up a total of $2,000, right? But let's just say your analysis says you think the market's still going to go higher, but you adjusted your stop loss to break even. Initially, your stop loss was, we'll say, down here, right? Your stop loss was down here, and now you moved it up here to break even, where you got into the trade. And you haven't taken profits or anything like that, and then let's just say a tweet comes out, news comes out that is unexpected, and it dips down to here, boom, hits your stop loss. And you stopped out at break even. So honestly, you didn't lose any money because you technically haven't been profitable any money. You've never closed the trade. But when trading intraday drawdown, that is how it works, because your account went up $2,000, and even though it lost that $2,000, then that means you blew the account. So how can you mitigate this? Well, for one, you can trail your stops aggressively. You aggressively take your profits whenever you're at certain levels. Or another one could be as you scale out, because if you scale out as it's going up, even though it dips down against you, it's not going to have as much value as it goes against you. So those are the three things you can kind of do to mitigate that kind of issue. Would be, like I said, you either take profits aggressively at targets, you adjust or trail your stop aggressively. One example could be using prior candle lows, in this case if you're going long. And then another one is scaling out and trailing your stop. So those are three things that can help you mitigate this. So but what is the pro and con of intraday, right? So con is obviously, even though you never were profitable, it obviously went against you and you still lose the account. That is the con to it. However, when it comes to the pros, there's a few pros, and it depends on trading strategy. And like I said, at the end of this video, I will talk about a strategy and how you could adjust to both of these type of accounts. But what are the pros? The pros are, well, they're cheap. They usually are very cheap to do because they are harder to do, and there's usually no daily loss limit. So in this case, if you were to use the advanced plan from Tradeify, which is intraday drawdown, there is no daily loss limit. It's just if you lose $2,000, you lose the account. If you use the growth plan, then or the even straight to funded or a straight to sim funded account, then there is a daily loss limit of $1,200, I believe, or maybe $1,500, something like that. You have to look at the website, which I was going to do and show on here, but the website is currently down for maintenance. So, but I believe you have a daily loss limit of, we'll call it $1,200. But say your account goes down to $1,200, it closes your trades, and then you come back and finish up the rest of it at the next trading day. And when I say finish up the rest of it, is the amount of risk you do have to trade. So that's an example of intraday drawdown. The pros and cons, like I said, pro could be if you don't like the daily loss limit, that's there, and it's also they are cheap to trade. And then we also talked about the con of how it moves up with you, but I did just give you 3 examples of how to help mitigate that. Now, the growth and straight to sim funded accounts, these have end of day drawdowns. Just like here, it's a drawdown that only updates at the end of each trading day. So in this case, um, you don't have that trailing drawdown behind you. So, and if we use this example here again, and it does dip against you, and say you stopped out at break even, you never actually lost the account because your account is actually still at 0. So it matters where the account closes. And how it works basically, you can fluctuate intraday. Your drawdown floor won't shift until the end of the day, and you've locked in the gain. So it only matters after you close the accounts, and it resets at the end of the trading day. In the example right here, you have your $50,000. Same thing. You have your $2,000 drawdown. Your floor is currently 48,000. Same thing. So it goes up to 51,500 middays, and it drops down to 49.5. But you close it at basically $500 profitable, and then the next day your we'll call it your loss limit there is going to be at 48,500 because you are $500 profitable, and that's where it closed on the day. So an example here of where this really works is on trending days, right? If you're a trend trader and you're okay with getting in and letting the market ebb and flow like this, right? Then it's okay to hold on to those trades because it doesn't work against you. So I really don't need to draw anything here. I'll probably pull up the chart to kind of show you what exactly it does. But like an example here would be, say you got in here. Actually, let's just pull up the chart. Let's do that. We're gonna pull up the chart. All right, so here is a chart, and we'll use this particular section here. This is the ES S&P 500 1-minute chart on the ES, and let me get rid of that right quick. Boom. All right, so in this case, let's just say you get into position. I'm looking for a trending type of spot where it's ebb and flowing, right? We could actually just say you think that the market's going to go long, so you get long off of VWAP here. Price pulls up and pulls back to here. So if you got long here, even though if you have an end of day drawing account, then actually you're okay here. But say it did pull back here, then your account is actually at a negative because it's accounting for this high here. But where it does help on the end of day drawdown is when it goes like this, right? That actually helps you, or it doesn't help you, but it doesn't actually hurt you at all. So it doesn't help you. I said that wrong, but it actually doesn't hurt you. So one thing we can do here is, as an example, which is say, and this is actually a setup we're going to cover here in a minute, but say you get long right here, you put your stop at the swing low. It pulls up, and that's okay. Like if you would want to take probably your profits right here if you're doing the intraday drawdown, but you see how it pulled back to here and then it even had a larger leg up. That's okay to hold on an end of day drawdown because it doesn't go against you. And so that actually would be okay to hold on, because as it fluctuates, it only matters where the account closes at the end of the day. So what is the pros and cons of a growth or a sim funded account? At Tradeify, or even TopStep does end of day. Top One Futures does both. Take Profit Trader, it depends which one you're doing. It's everywhere. Just make sure you know what you're getting involved in and know the rules before you're hopping in and what type of account you have. But the pro and con in this case, if we're going to use Tradeify with the growth and end of day, the growth accounts, with the end of day drawdown and the sim straight to funded is, well, the pro is, well, you have the end of day drawdown. So if you even stop at a break even, you're still okay. That's a pro, in my opinion. And it's really good for training days where you just hold on and let it go. You don't have to worry about taking profits too fast, and don't worry about if it runs without you because you get to hold on to it. Another con is, I guess, if you want to call it that, is they are more expensive to trade. There is, it depends on the trader really if you care about the daily loss limit or not. And also, the reset fees are a little bit more expensive at Tradeify specifically anyways. The reset fee is higher than they are, we'll say, on the intraday drawdown accounts. So it's got a little bit of give and take there. The end of day, or sorry, the straight to funded accounts, well, the it's just end of day as far as like your profit goal and all that stuff don't really matter because you're already funded. You don't have to worry about it. But that's really the pros and cons there, really, is the cost. You can't reset a sim straight to funded, so you don't have to worry about that cost there. So it's really just the growth side there. All right, so now let's go ahead and cover the strategy. So the strategy that is free to everyone that you could use on most platforms is really, and you work. Y'all know I work for Simpler Trading. Is the squeeze. Let me show you how you could use this for trading prop firms and day trading in general. All right, so first let's cover what exactly is. Put this here. Boom. What exactly are the rules to the squeeze? First rule. Is there a squeeze? And I'll show you how to identify that here in a minute. 2 is price at the entry zone. And if you're unaware, that is at the +1 or -1 ATR of the 21 EMA. Number 3, stacked EMAs. So when it comes to the squeeze setup, this is pretty much all there is that you need. And so when I say stacked EMAs, that is the 8 EMA, 21 EMA, and 34 EMA. So in this case, is the 8 EMA above the 21 EMA, and is the 21 EMA above the 34 EMA. And then for a short, that obviously be in reverse. So this is basically all it is when it comes to the squeeze. This is the rules. Now, where can we adjust it? And actually, I'll type this up here. So how do we adjust? So really, your stop doesn't change. Your stop is usually 1. I'll do +1 or -1 ATR from the 21 EMA. However, if you have red master into trade, you could actually increase it. If you want to not get shaken out so much, it should actually be 1.5 to 2 or -1.5 to 2 ATR away from the 21 EMA. So as you don't get wicked out and then it still keeps going, right? So that's the stop. That doesn't really change on the setups. Now, targets. What are your targets here? Okay, so if you're doing a intraday drawdown, I'll just put DD, intraday drawdown, well then your target should be the third ATR. Because by definition of the squeeze, your volatility and price is getting compressed. It's about to expand. There's a high probability that the price is going to go to the third ATR. The second and third ATR is the definition of squeeze. But if you have intraday drawdown, you have to be aggressive at taking your profits there and trilling it up quickly. Otherwise, because if it hits up there and then pulls back down, your intraday drawdown is going to work against you. So that is where you have to be very scalpy. You catch the pop, you get out and be happy. So that is if you're using your intraday drawdowns, and at Tradeify, that would be your advanced accounts, and at Apex, that's all of them are intraday drawdowns. So that is what you'd have to use there. Now let's just say you have end of day drawdown. End of day drawdown. So your target at your third ATR, you should definitely be taking at least some profit. So I'm going to put scale out. And then your final target would be I'll put final target is a histogram shift. And I'll show you what that looks like here in a minute. I'll give you examples of both of these. But this is the two difference here. So, like I mentioned here, let me get my little pin. So here's the main difference. The targets are different. Entry is the same, and your stop is the same. The variables here are your targets, right? All right, so now let me give you some examples of this, of how this actually works. Okay, so first off, you're going to need multi-time frame alignment. Multi-time frame alignment is very key if you want to be successful in this business. You need your time frames to align. So me typically, if I'm using the squeeze play, I like to have 3 time frames in alignment. So I'm going to use the 15, 5 minute, and 1 minute for these trades. And I'm also okay with taking them quick. Some people don't like the 1 minute. That's okay. Just adjust. You could do the 15, 5, 10, or sorry, the 15, 5, 2 is what I meant, the 2 minute. But say that's too short for you. Say you like bigger picture. Well, then you can go to like 30, 10, 5. Just adjust it like that. Whatever one best fits you. So now let's look for the like a setup. First off, how do we identify a squeeze? This is using the Squeeze Pro that is available at Simpler Trading. However, if you want to use the free version of the squeeze, it's on Thinkorswim for free, TrendSpider, so on and so forth. But you identify a squeeze by the dots down here. So the Squeeze Pro will have a black dot, which is a low compression squeeze. We have a mid compression squeeze, which is identified by the red dots, and then a high compression squeeze. Those are identified by having gold, and they don't happen too often. But if I find one as we're doing this example, I'll show you. But those are the 3 colors. All right, so now how do we trade this here? So we're going to use this day as an example. All right, so we have the 15-minute time frame right here is in a squeeze. The histogram is bullish. We identify it's bullish by it's above 0. So here's the 0 line, and it's blue. So that means bullish momentum on the 15-minute time frame. The 5-minute over here, the histogram, or we say that the squeeze did fire for a few right here, and then it is looking bullish right here based off of the squeeze firing, and then we also have stacked EMAs in that time frame. Excuse me. So if we're looking at this, okay, 15-minute and 5-minute is looking bullish. If we're just looking at, we'll say this time frame where the squeeze is firing on the 5-minute, then we come over here and say, okay, well, how do we place the trade here? Well, let's just say, all right, so they're looking bullish on the 15-minute, 5-minute. Now we have this really big squeeze right here building up on the 1 minute, right? So if there is a squeeze, you typically want to wait for about 5 dots. In this case, there's quite a few. But right here, you see how the histogram is going down? This is when you don't want to go long because the 5-minute, I'm sorry, you don't want to go short is what I'm saying, is because the 5-minute, 15-minute are showing bullishness. So you want to wait for it to shift. And it shifts by going blue up here. So now they're all showing potential bullish momentum, right? Upward momentum. So now once we get to here, which like I'll just draw a line so we can see where that potentially happens, is about right here, right? Okay, so now we have check, bullish, check, bullish. Now we get into position at the 21 EMA. The 21 EMA, you see this dark shaded area right here? That is within 1 ATR of the 21 EMA. So when price pulls back to about this zone, you would want to get long about right here, right? So we're long about here. Our stop, this is, you see how it turns into light gray? That is 1 ATR. It could be right there, but last swing low. Or you could even push it out a little bit to 1.5 like we talked about it here. Or you can even go 2 ATR below here if you wanted to. And then you just watch your position sizing and let price move. So let's just say we get long here. Or sorry, long is up here, and you either have your stop 1 ATR or 1.5, 2 ATR. That is really trader preference and how aggressive you want to be. There is no real right or wrong answer, but be consistent in what you're doing, because consistent in what you're doing is going to show you how consistent you are with your strategy. And a lot of this is going to have to deal with trading personality. If you do it too tight, say you only do at the 1 ATR, there's a chance you're going to get wicked out and then it spikes up in your direction. You're going to have to re-enter the trade. So the question is, do you have the mental capital, the mental athleticism to be able to re-enter a trade after taking a loss, after getting wicked out? However, if you are not, and most people don't, once they take a loss, they like to step back and just wait. But if you don't have that type of mentality where you can't hop right back in, then you want to decrease your position size and then have a wider stop at a, we'll say it, in this case, if we're looking bullish, at a -2 ATR or a -1.5 ATR. So remember, it's coming down to trader personality. It doesn't really matter how you do it; just be consistent in what you're doing it. But if you're capable of taking a loss and hopping right back in, then you could obviously be okay with keeping it tighter. However, if you're not, then wider is better. All right. So now we talked about that. We got along here. We'll just say most people don't have that mental athleticism, so we'll go ahead and say we have our stop at the 2 ATR mark down here, right? All right, so now we're into position. We have our stop. How do we know when to take profits? This is going to be the intraday drawdown method first. Price spikes up to the third ATR, which I personally coded these candles right here to be red, like, hey, price is getting extended. Then you go ahead, these are just Keltner channels where I coded them to be shaded, but if you use your Keltner channels 1, 2, and 3, these will print them out the same way, just not shaded. So once you get up here, that's where you would want to take your profits if you have intraday drawdown. And then, but the trade's not over yet, right? The squeeze never fired. It's still bullish. It hasn't fired yet, right? You would want that to be your, that's one trade. Now you wait for the pullback. Look, it's at the entry zone again with everything still looking bullish, right? Nothing changed on this time frame. Nothing changed over here. So this is your second trade. You get in and then you hold it up to the third ATR again. Boom, that is where you would take your profits again on an intraday drawdown. In this case, the squeeze did fire, which is identified by the green candles. And then it fired up there, and then now we're starting to get a little histogram shift up there. All right, so that's two trades up to the third ATR, close it, because if it pulls back, say you don't get out right here on the intraday drawdown and it pulls back, depending on your position sizing, that may stop you out or make you blow the account. It depends on how big a position you got on. Maybe you scaled in, just really clicked in as it went up. A lot of variables there, but this will work against you. But what you can do is long out, pull back, get long again, and take it back up. I'm okay with doing that. I do it quite often actually. But if that is something you can do, that is one way you could do it. And now the trade is over, and they're identifying the trade is over because the squeeze is firing, and then the histogram is shifting. So now we no longer have a trade. Momentum is slowing down. So that is on the intraday drawdown. But this is the same setup. Now, what can you do with the end of day drawdown? Well, same concept. Let's just say you got long here again, right? You long here, stop outside the second ATR. What do we want to do now? Well, if we're going to hold here, if price pushes up here, you don't have to close it because the squeeze never fired, right? And we'll talk about that again here in a minute. Is it in a squeeze? Yes. Our EMA is stacked. See right here, the 34, the 21, 8 EMAs are all stacked positive. I have them coded to be green. And then, so therefore, it's all looking positive, right? So there is that happening right there. And then, so it's in a squeeze, stacked EMAs, higher time frames are showing bullish momentum, and the 5-minute squeeze is starting to fire. Okay, so you get long here, pushes up, but say you don't take profits. Say you're waiting for this squeeze to fire. So it pushes up and it pulls back to here again. Now you have two options because you haven't closed the trade and it's starting to pivot here. What you can do is add to your position if you wanted, which is say you had one contract, now you just add to it, now you have two. And then you can adjust your stop actually to this last swing low right here, and you'll still be okay. And then price pushes up, and then where would you want to close this trade? Well, when the histogram, by definition, and according to John Carter, JC, the creator of the squeeze, is you want to wait for two histogram bar shifts. And where's that identified? That is identified right here. So you have two, right? And let's go ahead and just draw it straight up. You see from up here, right? So you can either scale out at the third ATR and wait for the shift. Choice is yours, right? But that is one way you can trade it if you have end of day drawdown. So let's talk about that again real quick. So if you have, I'll put I for intraday drawdown, you're closing at your third ATR. Okay. But if you have end of day, you're waiting for the histo shift. So that is two ways you can trade those type of drawdowns in your account. So like I said, But yeah, that's pretty much it. That's all I wanted to cover there. So I hope you found this helpful. Like I said, intraday, just a quick recap. Intraday drawdown occurs in real time as price moves up. Your high water mark, that is where your $2,000 high mark starts. And if it pulls down 2,000, in this case, the $50,000 account, anyways, that's where your drawdown starts and it pulls back. That is where it's going to trigger you. If it's end of day, you could hold on through those fluctuations, and what matters is where you close the trading day at. Each has its pros and cons based on price, reset fees, things like that. It really comes down to trader preference. I also did show y'all a strategy that is free across most platforms. I'm using the TTM squeeze provided by Simpler Trading, and it does. The main difference there is if you're using an intraday drawdown, once you get that third ATR, take your profits, look for your next setup. Like I showed you there, you can take your profits, wait for the dip again, take your 2 trades. If you're doing end of day drawdown, same thing, except you can allow it to play out waiting for that histogram shift to hold. This will allow you to hold on for large moves throughout the day. And that's just a little pro and con of each one. That's really good for trend traders that really want to hold on till a trend changes. And also offered opportunities to add to your position and adjust your stop without having any repercussions. And once again, like I said, if you found this helpful and you like this channel, I am going to be putting more day trading features content out there. Uh, like I said, if you found this helpful, like, share, ask any questions, the typical influencer thing. I'll call it what it is. But if you have any questions, seriously, if any of this didn't make sense, feel free to ask. I'll be more than happy to help you out. And if you're looking to purchase any of these accounts at Apex and Tradeify and whatnot, use code ACT to help support what's going on here. But all you have a fantastic day. And if you have anything you think you want covered, feel free to ask away. I'm looking for ideas in the realm of prop trading and day trading features and strategies and things like that. All right, that's it. Have a fantastic one, everyone, and take care.